But there's people that there's a risky side to it, very risk heavy, and people that are very risk averse. So the way you approach it depends on how much you're willing to lose. But the stock market itself is not based on risk management. It's based on speculation. So cut that out. So yes, it's sophisticated gambling. But there's different layers and levels to it. There's different people who gamble on top of the gambling, like side betting. So there's a whole world of side betting that surrounds like the actual stock market. Then you got people who bet on the stock market itself. It's super interesting. Then you could bet on the people who bet on the stock market. You could bet for things to go up. You can bet for things to go down. So yeah, it's a crazy place where people find a lot of ways to make money. Wherever there's money, there's many different ways to make money off of that money or how that money moves. But the money has to be moving. Money that's just sitting, doesn't necessarily prevent any opportunity for growth in a direct way, in a way that you can force. So actually, money that's sitting is probably more susceptible to inflation. But anyway, I'm not going to get into a heavy economic conversation with the folks. And no, I don't invest in the stock market. I don't gamble. So. Is the GameStop stock spiking from a coordinated effort the beginning of a virtual revolution on stocks? I don't think so. I don't think so. It's focusing on one specific aspect of the market that can be, if you don't want to call it manipulated, that can definitely be gamed, and it's like short selling. So they made money off short sellers, like pushing short sellers to what is it, to buy more stock or to I don't know, it doesn't matter, but pushing short sellers to come out of their positions, and that creates a sensation in the market of the stock. People want the stock, the demand is going up, so the price starts going up, and basically they just push this price up. But that's one company and a few sets of companies where people are heavily shorted on it. But you can't do that to the rest of the market. So I don't think so. But it's a good way to but you gotta think, when you talk about like hedge funds are leveraged all over the place, so you might have some that are they might have shorts, they might have longs, they might have bonds, like who knows, like depends on the fund that you're in. But yeah, if you're shorting this, it may show a chink in the armor of shorting. But then I think they were saying that, I only read I think one or two articles about it, but one of the things that they said was like GameStop specifically is it's more than just the price of the stock. It has like a what do they call it? A meme value. I mean, people appreciate it for its brand value, its history, blah blah blah. Could it potentially have had a general turnaround on its own? Probably not. So are there other companies that are like that? Like what you would have to do for other companies like that? Like little known, well, GameStop's not little known, but maybe not really thought about in terms of investing in. You think about Amazon or some tech stock or some bio stock or something like that. But you wouldn't think about GameStop. Like, yo, let's go invest in GameStop. If you do all the due diligence and the market research, you're like, nah, this thing finna sit at $20 for the next 1,000 years. But if you can find, if it's heavily shorted, and then it has all these other kind of factors, then maybe. But I don't see that happening for the entirety of the market. So it's not. I don't think it's illegal, but the powers that be, the shorters and the hedge funds, they got juice. They got a lot of juice. So